Welcome to the Deep Dive. Today, we're jumping right into the Q2 Fiscal Year 2026 results for CarMax, ticker KMX, reported September 25th. And what a report it was. We've got this huge earnings miss, a really dramatic market sell-off, but then also some very aggressive forward guidance. Our job today, unpack that pain and understand the plan they laid out. Less than 10 seconds. Let's go.
Yeah, it was quite the shocker for investors, frankly. We really need to start with just how big that surprise was.
Absolutely. I mean, a 38.5% negative surprise, that's not noise. That's a major signal. Earnings per share, just $0.64.
Right, when the street was looking for, what, $1.04. So, yeah, a massive miss there.
And it wasn't just the bottom line, was it? The revenue side felt the pressure, too.
Oh, definitely. Total net sales and operating revenues, they dropped 6.0% compared to last year, came in at $6.59 billion.
And the estimate was over $7 billion, like $7.04 billion.
Exactly. So missing by nearly $500 million on the top line. When you miss both like that, well, the market reaction is predictable. And it was severe.
Severe is right. The stock just cratered, didn't it? Down, what, almost 23% in pre-market trading?
Yeah, 22.59%, pushed it right down near its 52-week low. That kind of move, it tells you investors are really questioning things in the near term.
So it forces the question, what happened? Why did sales fall off a cliff like that?
Well, management, they pointed to a couple of interconnected things, really, starting back even before the quarter began.
Okay.
First, they mentioned a pull forward of demand into Q1. Some of that might have been people worried about tariffs, trying to buy earlier. So CarMax ramped up inventory, expecting that momentum to continue.
Right. They stocked the shelves, ready for the party to keep going.
And then the music stopped, or at least changed tunes drastically. The second factor was this rapid depreciation, about $1,000 per vehicle, hitting sort of late May through June.
Ouch. Right after they'd bought all that inventory at higher prices.
Exactly. Suddenly their cars weren't price competitive. That inventory overhang really hurt them in Q2.
And you see it in the unit numbers. Comp store sales down 6.3%. Overall retail used units down 5.4%. Those are pretty steep drops. Suggest their core customer might be feeling the pinch or just waiting.
Yeah, it definitely raises questions about that mid to high FICO consumer base. So their response in Q2, they basically had to cut retail margins to move those cars.
Get the metal moving, even if it hurts the profit per car temporarily.
Right. And they slowed down buying, too, trying to get the inventory levels back in balance.
Yeah.
It just highlights, how tricky inventory management is in the used car space when prices get volatile.
But, okay, so despite that volume hit and the margin cuts to move cars, the underlying profit per vehicle actually held up, didn't it?
Yeah, that's the kind of surprising part. Gross profit per retail used unit was $2,216, almost flat year over year. And wholesale was $993, also stable.
So they still know how to buy, right, recondition efficiently, and sell for a decent profit per car. The machine works.
The machine works, they just didn't feed enough cars through it in Q2. The total gross profit dollars fell sharply because of that volume decline.
And that leads directly to the SG&A issue, right?
Yeah.
The deleverage.
Exactly. Let's break that down. SG&A itself, selling, general, admin costs, actually went down slightly, 1.6%, mostly lower stock compensation.
Okay, so spending was down a bit, but deleverage means...
It means your costs didn't fall nearly as fast as your gross profit did. So those costs become a much bigger percentage of the profit you did make. SG&A jumped to 83.8% of gross profit. That's up 350 basis points.
Oof. Shows the burden of those fixed costs, the stores, the tech platform, when volume shrinks.
Precisely. It's a vulnerability when sales slow down that quickly.
Okay, let's switch gears a bit. The other big story here was CarMax Auto Finance, or CAF. That seems to be where a huge chunk of the earnings miss actually came from.
Absolutely. CAF income was down 11.2% to $102.6 million. But the real headline within CAF was the provision for loan losses.
That jumped up significantly,
up 26.3% year over year to $142.2 million. And the key thing here, the really crucial part, is why it jumped. About half of that increase, $71.3 million, wasn't for losses on new loans. It was an adjustment, a catch-up, for expected lifetime losses on existing loans.
Ah, the ghosts of loans past. Which ones?
Specifically, the 2022 and 2023 vintages. Management was pretty clear about this.
Why those years particularly? What was going on then?
Think about it. That was peak weirdness, right? Used car prices were exploding, hitting all-time highs. At the same time, you had broad inflation hitting consumers everywhere else.
Right. So loans written when collateral values were inflated and borrower budgets were about to get squeezed.
That's the theory. Those specific loans originated in that environment are just underperforming expectations. They're still profitable. Mind you, management said they expect about $1,500 profit per unit over the lifetime, down from $1,800 originally.
Still profitable, but that downward revision means taking a bigger provision hit now.
Exactly. You have to recognize that expected future loss today. But there's a positive note here. They stress that the loans originated after they tightened their underwriting standards, specifically after April 2024. Those are performing right in line with what they expected.
So the problem is contained to those specific older vintages? They feel like they've corrected course on new lending?
That's the message, yes. And outside of that provision adjustment, the core CF engine actually looked okay. The interest margin, the spread they make, grew nicely to 6.6%.
And more people finance through them?
Slightly. Penetration ticked up a bit to 42.6% after accounting for quick payoffs. So operationally, CF was doing all right. It was just that big legacy provision hit.
Okay, so that covers the pain points. But then came the forward-looking stuff, the strategic shifts. And there was a big one related to CF, right? Happened just after the quarter ended.
Yeah, this is potentially a really significant structural change for them. On September 24th, they did their second non-prime securitization of the year, $900 million deal.
We've seen them do securitizations before. What was different this time?
The big difference was they sold most of the residual financial interest to other investors.
Okay, translate that. What's the residual financial interest, and why does selling it matter?
Think of it as the riskiest slice of the loan pool, the part that absorbs unexpected losses first. By selling that off, CarMax essentially transfers a big chunk of the credit risk for that specific pool of loans off its own books.
Ah, so it gets off-balance sheet treatment.
Exactly. That's the key. For that $900 million pool, CarMax is now basically just the servicer. They collect payments, but they don't hold the primary credit risk anymore.
Which means no more provisions for losses on that pool in the future.
Precisely. No loss allowance, no provision needed going forward for those specific loans. It's a direct move to reduce the kind of earnings volatility we saw hit them so hard this quarter from their non-prime book.
And there are immediate financial benefits, too.
Yep. They expect a gain on that sale in Q3, maybe $25 to $30 million. Plus, ongoing income over the life of the deal from servicing fees and the small piece they kept, maybe another $40 to $45 million. It's a smart piece of financial engineering, really.
Okay, so that addresses future CCAF volatility. What about the SG&A side, the cost structure?
They tackled that head-on, too. Announced plans for at least $150 million in incremental SG&A cuts over the next 18 months.
$150 million. Is that enough, or just optics after such a bad quarter?
Well, they're framing it as structural. They said the savings will come from modernizing tech, using more AI. They mentioned something called Sky 2.0 agentic AI and automating manual stuff. The goal seems to be permanent efficiency gains, mostly hitting the run rate by the end of fiscal 27.
So not just temporary belt tightening, but trying to fundamentally lower the cost base, which, given the deleverage issue, makes sense.
It does. And despite this really rough Q2, they didn't back down from their long-term goals.
Still aiming high.
Yeah, still talking about mid-single-digit retail unit growth long-term and high teens EPS growth on a COGR basis. They also still expect to gain market share for the full fiscal year, even with this Q2 stumble.
That's confidence. What's backing that up?
They point to their omni-channel model, customer satisfaction. Apparently, their net promoter score is at an all-time high since they rolled out all the digital tools. And they're putting money behind it.
New marketing campaign.
Yep, launched in late August, called Wanna Drive. Focuses on that blend of online and in-person experience, customer empowerment.
And that means spending more on ads.
Looks like it. They said ad spend will increase in the second half, especially Q3, to support this campaign. They clearly believe they have the right model. They just need to get the execution and maybe the market environment back on track.
Okay, one last piece of guidance back to CSF for a second. That big Q2 provision hit did force a change to the full-year outlook, right?
It did. They had previously expected CCAF income to increase for the full year. Now they're saying it'll likely be flat to slightly down compared to last year.
And that change is pretty much entirely due to that big Q2 legacy loan adjustment.
That's the takeaway, yeah. It was a one-time hit related to those older vintages that reshaped the full-year picture for the finance arm.
Okay, so let's try and wrap this up for you. A really painful quarter financially for KMX. Big misses on earnings and revenue, driven by that sudden price depreciation hitting their inventory and that large provision charge on older loans. Just Ouch.
Yeah, the backward-looking numbers were definitely rough, but then you have this very decisive forward-looking response.
Right. The structural cost cuts that $150 million target. The renewed marketing push with Wanna Drive, and
Yeah.
maybe most significantly, that shift in how they handle non-prime credit risk through the off-balance sheet securitization.
That securitization move, selling the residual, is the really interesting piece of financial engineering. It's designed specifically to insulate earnings from that non-prime loan volatility that bit them this quarter. You couple that with the cost savings target, and CarMax is clearly trying to build more financial resilience, more flexibility.
Which brings us to the final thought.
Exactly. The big question for you to think about is, if this financial engineering works, if they stabilize earnings volatility and lower their cost base, how quickly can they translate that newfound flexibility back into offense? Can they start using price and selection more aggressively again to grab that market share they're aiming for? Especially if the consumer, even their more creditworthy customer, remains a bit cautious with inflation still high and interest rates up there. Achieving those ambitious long-term growth targets really hinges on making these strategic plays work, and work quickly.